I think we've seen that with compute, on the virtual resources side, where I do think the why now is AI demand, and the demand for both inference and training. And in that context, compute is like electricity, in the sense that no one ever says, "Hey, we have enough electricity." It's like the more you have, the more you can do with it. And I think that's been a structural tailwind that I think is making viable a lot of these decentralized compute plays today, where 2, 3, 4, 5 years ago, pre-transformer, it just wasn't that significant of a need.
Quick shout out to today's sponsor, Ekiden. We'll hear more about their decentralized club on Aptos later today, but for now, let's get into the episode. What's up, guys? This is Boccaccio, the bad host.
And the better host, Danny.
Today, we have a very, very important announcement for you. We are hosting Permissionless in Brooklyn. What dates?
It's going to be in June 24th through the 26th.
Very good. You can use code 0x10 to buy your tickets. We're going to do lots and lots of stuff. Dinners.
Games. You'll get to meet the whole crew, the OX research crew, hopefully a bunch of the Blockworks research and other Blockworks crew, and maybe a dunk tank.
We're going to have fun. Whatever we can smooch off of Yano and Mippo, we're going to do it. So if you are a 0x research listener, make sure to use code 0x10 to buy your tickets. Danny, any parting words?
And we'll see you there.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed. What's up, guys? Welcome back to another episode of 0x Research. Today I'm joined by Dmitry, who's a partner at Archetype. Thanks for joining us, Dmitry.
Yeah, for sure. Thanks for having me.
Before we get started, I remember you were at somewhere else before. Maybe do you want to give a short introduction of what you've been up to over the past few months, and your background?
Yeah, I mean, investing in crypto for a while, since 2018, across a number of funds, Coin Fund, a crypto family office called Bollinger Investment Group, 1KX, been with Archetype since last January. Work has been the same throughout the years, generally investment, due diligence, research, and portfolio support. I cover things like DeFi, payments, DePIN, interop, and scalability. And I work with teams around go-to-market, token design, and follow-on fundraising.
Perfect. I actually remember reading a few of your Medium posts. I think I may have copied a few of your thoughts and key takeaways back in my original when I first got started in crypto. So I'm excited to be able to actually chat to you, and then maybe also going into the future copy some more of your takes.
Yeah.
But I mainly want to talk to you about DePIN. I think that's DePIN payments and maybe some AI today. But primarily, I'm semi-ignorant about DePIN, and I always bring this up to VCs because VCs are typically involved with DePIN. I think it's more of something that's coming up and not something that's very liquid right now. Do you want to maybe share your thoughts on why DePIN hasn't succeeded? Or I guess, what would you say would be success for DePIN and why it hasn't achieved that yet?
Yeah, I think there's two components. I think the first is, I would argue, certain projects have been successful. It took a while. Helium today, I think they have around 700,000 subscribers and 23 terabytes of data that is being offloaded by their network. It took a few years, and I think they admitted, saying the IoT approach probably wasn't the thing that gave organic demand. GeoNet has a few $1 million of revenue. They committed to burning 80% of that into their token. Storj has a bit over 10 million in ARR, but that is in their off-chain devco. opco. So it took a while. I think the issues have generally been twofold. One is that you needed to get to parity to your centralized counterparts on the demand side. And I think that's having very basic SLAs, it's abstracting anything blockchain, and it's communicating it the right way. Because I think while we might have a certain value here, really in the, let's call it the real world, nobody buys decentralization for the sake of decentralization. So they buy lower costs, they buy resilience, and I think it's been a learning process from a lot of these projects. The other issue has been this disconnect, as you mentioned, between almost private investor interest, value accrual on the equity side, and the reflection of that on the liquid markets. And I think that is still a work in progress. A lot of the patterns with these DePIN projects is they have a protocol, and that can be a foundation, and then they have a opco or a devco that pays the network, but then they receive in fiat payments from their customers, whoever they are. And with a lot of these, the value flow is not really fully there yet, between like
Yeah.
how do you actually convert that. And look, a lot of it is concerns around securities laws and whatnot, but I think a credible commitment to value accrual in the token, I think, is something that the liquid markets are looking for.
I think that makes sense. I feel like a lot of other sectors had a second iteration of protocols where tokenomics were adjusted to reflect some form of value accrual. And DePIN, it seems like it never really had that. Like the demand side for the token never really came, just because there was no value accrual. And one thing you brought up is the idea of um, the back end is kind of complicated in terms of the token. Is there's like equity side, and then there's the lab side, and then someone's paying in. Do you think with, I guess, better regulation, that will change? And is that something that you guys focus on, and that we want to make sure that, like, if we're doing a deal, I want to make sure that there's a proper setup in place such that equity and token, it's very clear we're not like doing something that shouldn't be done. Is that something you guys think about?
Yeah, absolutely. I mean, I think the issue is really the credible commitment to it, and it's very much like founder DNA. And I do think there's probably a bit more risk in involved, but I think that is part of accessing, let's call it, like the token capital markets. And I think there has been this return to fundamentals over the last few months, and I think, ARR is the new TVL. And
Yeah.
and I think like we've been looking very deeply into actually what revenue is there, because I think for I definitely for DePIN, the idea that you can use token incentives to bootstrap a supply side, that's no longer an argument. Of course, it works really
Yeah.
well, and crypto is really good at incentives. And now it's how do you build a good product on the demand side, and how do you have, it goes back to startup 101, like who is your user persona, what are you building that actually solves a shark bite and not a mosquito bite for them, and how do you have a willingness to pay, and then how do you have a structure where you clearly outline how that value accrues to the token. What a lot of founders have done, and I understand why they did it, they basically say, hey, we don't have a lot of dollars in the treasury left. Our token FTV is low. We are going to raise again, from a new equity opco, of which owns a small percentage of the token supply. And then we're going to argue that this separate equity co accrues value. And imagine that opco holds 5% of the token supply, and then they sell 10% of the opco. So what the investor is getting is usually a tiny subset of actual exposure to the token network. You're getting 10% of 5% effectively, and you balloon the FTV to the point where then it almost doesn't make sense as an investor. If you're excited about the network, you just buy the token, and then a lot of founders are stuck between a rock and a hard place. And I think the right structure is to have a credible commitment over, again, the flow through between the revenue accrued by the opco and the token network. And if you are actually raising funds into the opco, to be sure to structure it where investors are getting roughly a one-to-one flow through across both instruments. And that is really just also optionality as well. And it's a conversation where there's still friction today.
Yeah, I think that makes sense. And one other thing that I've noticed with DePIN, I mean, this can be said about a lot of projects, but I feel like DePIN projects typically suffer from this, is on, I guess, DeFi coins or any non-DePIN coin, there's kind of a focus on making sure that the markets are liquid. Versus I feel like most of the time when I'm looking for a DePIN token, like on the liquid, for our subscribers, for example, for Blockworks Research, I feel like there isn't stuff that's particularly liquid. So would you say that the DePIN, I guess, in general, that side doesn't particularly focus on making a token investable for liquid funds, and more so is like, we need to figure out a way to incentivize users, which is clearly the first thing that they need to do. Like, they need to bootstrap growth and make sure that people want to use the network. But do you think that they often avoid it, or is that something that I'm just kind of
I actually think it's not intentional by a lot of these founders. I think the interesting part about DePIN is that it attracts a different kind of founder persona, which is almost like the electrical engineering PhD that found issues in their own market structures across telecom and energy and mobility, and they say, okay, like, we can use tokens to solve this market dislocation. But they're often not super crypto native, and I actually think it's not something that they intended. And I've gotten to certain founders saying, we'd like to do a treasury diversification for you, and they said, please buy on the open market. But I don't think they thought about the mechanism to structurally have at least 8 to 12% float. I do think it's top of mind, and it's solvable over time as you are giving more rewards to users. Both the supply and demand side, and then that becomes more liquid. But I think for funds like us, depth actually continues to remain an issue, and I do think there's the intention from founders to want to address it.
Today's episode is brought to you by Ekiden. Ekiden is a decentralized order book-based exchange built on Aptos with a mission to create a scalable, institutional-grade trading platform. To learn more about Ekiden, follow the link in today's show notes.
As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
I want to take a step back and speak a bit about what a DePIN network, or like how you guys would approach a DePIN network investment. When, let's say, it's a telecom company, or like a telecom DePIN, what would you say they need to focus on? Is it like underserved communities, or is it just like where there's a gap in the market in, like, I guess, a bigger market? Is it what should they be focusing on in that sense? And is there anything that was happening, I guess, 2 years ago, 3 years ago, that is now you're like, we definitely should not have been doing this back then? Like, this didn't make any sense, in the sense of like how they were offering the product, how they were approaching the market, etc.
That's interesting. I think for a lot of these projects. What we think about, and one of the most important questions we ask is why now? And it's really looking at what are the inflection points in the industry that the founders can almost leverage as tools or weapons to shift the future into their vision. And I think that applies to things like, I mean, across telecom, energy, mobility. This can be new technology advancements like having more wireless capabilities and being able to transmit data without needing to actually have wires installed. It can be economics around the actual hardware. So today, for example, it is cheaper to install and buy a new solar panel than it is to maintain an old one. And I think like the unit economics there make a lot of sense. And so that is, a trajectory in solar that I think is very exciting. And it's asking the question of what is naturally going to become decentralized, and where can you start to apply crypto incentives to actually create a functioning network. So I think we pay a lot of attention to market structure, and for a lot of projects, it was simply too early. I think about the Webvan example, where that's basically Amazon Fresh today, but that was 20 years too early, and investors burned a lot of money on it, and at the time there wasn't mobile and there wasn't a lot of internet penetration, and I think about that a lot. I think we've seen that with compute, on the virtual resources side, where I do think the why now is AI demand, and the demand for both inference and training. And in that context, compute is like electricity, in the sense that no one ever says, "Hey, we have enough electricity." It's like the more you have, the more you can do with it. And I think that's been a structural tailwind that I think is making viable a lot of these decentralized compute plays today, where 2, 3, 4, 5 years ago, pre-transformer, it just wasn't that significant of a need.
Yeah. I actually wanted to ask about decentralized compute as well. That's another thing that was on my mind. That do you think that's just it's overcrowded? There's way too many decentralized compute marketplaces, or do you think it's just not the right time yet, and we need to wait a few years where the demand really goes up a lot more?
Yeah, I think it's crowded, but it's like, I think it's a good thing, and I think there's a lot to innovate around the approach, where I don't want to call out certain projects, but the way that orchestration and routing is done today is quite elementary. And I think there is still this vision around, how do you coordinate heterogeneous resources to actually provide a coherent project to a demand side. So from 4090s to A100s, how do you find a way to split a workload and distribute a workload where you're not bounded by the weakest link, which is the weakest machine on your network, and that's a very difficult problem. And there's been interesting approaches recently around, for example, how do you split the model itself and then route different layers to different machines depending on what you have to do. We recently spoke with a senior exec at OpenAI who is leaving and starting his own decentralized compute project, which is doing exactly this. And he said that, I don't see myself as a crypto or blockchain company. I just see blockchains as the right tool for the job. and I think that was, inspiring, I suppose. We're because we are seeing very impressive practitioners now coming into the space, and I think we'll have a lot more sophisticated approaches and actually like getting this performant, because it's still a huge issue. We spoke with this one company the other day that's doing deep fake AI video production. So I can, in a prompt say, like, generate Dmitry as the Pope, and it shows a video of me as a Pope, and it costs them $1.40 per inference, and the unit economics on that just don't work out. If you have any meaningful attraction, and Sora probably has millions of monthly active users. If you get beyond 10K, that doesn't work. So I think that's where these decentralized compute projects can be quite impactful, because I do think we need to get those costs down to cents per inference.
I want to ask a bit about that cost thing because, and please treat me like I don't know anything about this, which is the case. I don't know anything about it. If I am a decentralized compute, I guess marketplace, how am I competing with regular compute marketplaces? Like, what is it? Just at a steep discount, or is it? How does that work exactly on that end?
Yeah, it's often the discount and the supply of machines. Like, what is your supply? Are you aggregating, individuals with 4090s, or are you aggregating tiny data centers with A100s or H100s? So the supply side matters a lot. A lot of these decentralized compute projects say they have some data center, but do they actually own the supply, and how sticky is that supply? A related component is the actual model layer. So are you serving and hosting open source models as well, or performant open source models? I think that's another component. So I think those are generally the two main vectors.
That makes sense. And are they verifiable in terms of, like, if they're saying this, you're using an A100, is it typically that, or is there a risk that it's not?
I think there's a risk. I don't have a lot of visibility on how verifiability is done today. I think it remains an issue. I do think it's trust me, bro. Um, but also you can't have this fully on chain, because the moment you do, you lose any real performance and cost benefits. And again, I don't want to name any specific project, but we've seen the issue, and I do think there's a spectrum of verifiability, and I do think some spectrum of trust is probably okay in the short term.
Yeah.
But yeah, I would be surprised if we had any trustless mechanisms to say your inference is coming from this specific machine type. I think you probably see it indirectly in the I don't know, the time spent training or the time to produce an inference.
Yeah. Only if something is wonky would you realize, okay, well, this is probably not right. I'm being lied to.
Yeah, like this is taking too long, or this is way more expensive than I thought.
Engineered to meet the demands of high-frequency traders and regular traders alike, Ekiden redefines on-chain trading with lightning-fast performance and decentralized security. Ekiden's building a scalable, institutional-grade trading platform with execution speeds as low as 5 to 15 milliseconds, deep liquidity, and zero maker fees that leverage Aptos's cutting-edge technology for both spot and perpetual futures markets. To learn more, follow the link in today's show notes, and thanks again to Ekiden for sponsoring today's episode.
As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
I'm going to switch over to payments and stablecoins. we have a conference called DAS, which was like 2 months ago now, and ever since then, this is all I can hear about and talk about is stablecoins. I want your thoughts on first stablecoins. Do you see there being a single winner, or I guess like USDT, USDC? I would say is like a single winner at this point, together, even though that doesn't sound right. Or do you see new stablecoins popping up, bank stablecoins? They're just like all of Web 2 coming in and saying we're going to launch our own version. How do you see that space shape up?
Yeah, I mean, I think categorically there will be more than one winner because there's more than one flavor of stablecoin, and in the one-to-one backed realm, yes, I would argue today it is USDC, USDT. We will also see both fintechs, larger financial institutions, and large tech companies come in, and that's going to be really interesting fireworks to see. Having PMF is a double-edged sword in that regard. But there's also, the crypto-backed stable coins. There are the yield-bearing stable coins. Some have yield as the product where it's baked in. Some have yield as a go-to-market where it's not baked in directly into the asset, but the company uses that as a go-to-market where they pass on the yield. There are non-US dollar stable coins, and like not highly inflationary ones, but that's been popping up across different countries around the world. There's stable coins that pass on non-treasury yield. This can be high grade sovereign debt as well. So I think there's going to be actually a few winners in a lot of those, and maybe it'll take longer for non-US dollar to have a use case at scale. There is around $600 million of non-US dollar stablecoins issued today, compared with roughly $230 billion of stablecoins in general. That's from Artemis. So let's see how long it takes for that to catch up. And then another framing is, closed loop versus open loop. This terminology is from payment networks. So a lot of like what we are talking about is open loop, where it is freely transferable, and it's meant to be a medium of exchange. There's the other use case where you have a fintech who mints a stable coin and keeps user deposits into that stablecoin to earn treasury yield on it. And Venmo already does this today with your user deposits, and this really enables any company to have a business model that is effectively what Venmo does today.
Yeah, I feel like in my mind, most of the Web 2 that comes in will end up doing that. Just capture whatever they can off chain and then allow for some form of quicker settlement. You mentioned non-USD stablecoins. I feel like this is, I don't know what you got. You like, obviously you've spent more time thinking about it, and you probably understand this better than me. But in my mind, so I'm originally from a country that has very high inflation. So everybody just wants to hold the US dollar. Like we've always seen people want the US dollar, sometimes the euro, but not as much. I feel like like euros, I guess the Swiss franc, I feel like that'll always be like maybe sub 10%, and the majority will always be US dollar. Is that correct in thinking, or do you think we see a shift?
I think so. I mean, I don't want to sound too American, but the US dollar relatively is arguably the strongest currency. So I think whether it's a business type use case of holding your treasury in an asset to, a family in an emerging market, I think the ideal pattern is that they are able to hold funds in digital dollars, but pay in local fiat. And so that the off ramp and the FX, the FX happens at the off ramp, I suppose. And I think that is probably the pattern that most want, assuming that you can do that without much friction. I've been thinking about the case of why tokenize non US dollar. I think there is an angle around FX markets, bringing FX markets on chain. Um, uh, I think that's very interesting. Um, where the gap is in my head is, what is the demand for, and it could be a market maker, it can be an exchange, to hold the fiat in a tokenized form rather than just on balance sheet.
Yeah.
And I don't quite have that answer in my head yet. I do think there will be a pattern where more local exchanges are tokenizing the local currencies in where they operate, and it might be a play for them to participate in FX markets more. Let's call it like B2B FX markets, because they already play in FX today, just by nature of the liquidity, where um, you can effectively use Bitcoin as a cross rate for between two different currencies. So US dollar to Bitcoin, Bitcoin to Mexican peso, you can actually get very tight spreads. And so a lot of payment companies are already using the byproduct of speculation, effectively, as quite an attractive business prop for themselves. And the question is, okay, like, they already are being used for that. What is the benefit of those assets actually being tokenized? I haven't yet gotten there, but it's an area I've been diving into.
Interesting. Surely it's to, I don't know if anybody has ever dealt with converting currencies. I feel like that process definitely needs to become a lot more efficient. So I think that's like a reason to at least I don't know what it's like in the US, to be honest with you. And I know Web2 companies take a spread not as bad as what you would get if you just try to exchange fiat for fiat. But um, that kind of brings us to payments. Um, and I feel like I can ask this question about every sector in crypto right now. But what's we've seen a decent number of crypto banks coming in. EtherFi is the big one that I would say is like more crypto native. Now we have Stripe working with Ramp and Bridge. Is it Bridge? I can't remember the name. To
Both.
build out something as well. I feel like that'll actually be useful. But the main question here is, do you think somebody just comes in and swoops in, like a Web2 company, and offers the best UX that they can just by having stablecoins on the back end? Or do you think there's a chance for crypto native companies to win out there? And the follow up to this is, how do you see that space evolve over the next few years? Because I really want actual crypto banks.
Yeah, for sure. I mean, I think you can take a step back and look at this as an evolution across several decades, where you have payments 1.0, which was effectively correspondent banking powered by Swift. And this was a network that, it's global, it's secure, but it's very slow, and it takes days to weeks. I've heard from founders over a month to have a payment land. And then you have, payments 2.0, which was effectively these fintechs like Wise, which used pre-funded accounts, local rails for pay-ins and payouts to effectively simulate real-time payments. So they effectively have liquidity pools in each jurisdiction. And while that effectively is faster, it came with a lot of other issues. Notably, it's still quite OpEx expensive for them, because they need to maintain complex treasury and compliance infrastructure. They have to have multiple local correspondent banking relationships. They need to have risk engines to manage float and FX volatility. And I think payments 3.0 is really using blockchains and having this internet native settlement layer. And now we can do transactions in the order of seconds that cost in the order of cents. And there's no evening or weekend or holiday cutoff times. And it's fully transparent, so you always know where your payment is. And I think, a similar question to a lot of the DePIN advancements is the why now, because this is a topic that's not new, but I think the why now is we have stablecoins that are mainstream. We have better on and off ramps with more depth, because those local OTC desks and market makers, they do want to hold non-volatile digital dollars on balance sheet along with their local fiat. We have embedded wallets like Privy that actually give us a Web 2 like UX. We have pending clear regulation around Stable Act and the Genius Act. And I think we're really opening the floodgates for both fintechs and larger financial institutions to come on chain. But it's a double-edged sword for let's call it the crypto incumbents, because what crypto teams really suck at is solving for distribution, and Revolut alone has 60 million MAUs. And I think the conversation today is very different than it was 3-4 years ago. I remember probably 2020 or 2021. I met the head of BD at Chime, and I asked them, Chime's users are middle income Americans in like central US states. And I said, wouldn't it be nice if you gave them access to DeFi yield? And the guy was like, I don't want anything to do with crypto. I'm so busy trying to not die competing against the big banks that I don't want to take any more risk. And today the conversation is flipped, where Revolut has their own exchange. They have some really interesting other products in the pipeline. You see it with Robinhood and obviously Stripe. And a lot of the DeFi projects, like the crypto neobanks, they are good products, but they do not solve for distribution. And if you can figure that out, then I think the DeFi mullet is probably the best way to go. But it's going to be very team specific. But I've spoken to many, let's call it high pedigree founders that are building a crypto neobank that cannot answer how they will get to, I don't know, like 1 million users.
Yeah, it's especially kind of disheartening because Revolut, if you have a paid Revolut account, they give you maybe $30 in incentives per month, versus in crypto, to acquire a new user, you're A, giving up equity, and B, you're also just spending millions of dollars potentially across like 6 months, and people don't stick around. So yeah, it's distribution is one. I want to challenge you on the Privy being good UX. I don't think we've solved, this is not a hot take, I don't think we've solved UX at all. I still feel like it is absolutely horrible. And the main reason I think so is that we don't build mobile first, we still build web first, which I feel like is ridiculous. For even for a payments app, it should be mobile first. So I guess first, what do you think about that? And second, if you do talk to teams, do you tell them, hey guys, like you have to build a mobile app? It's non-negotiable.
Yeah. So I agree that we haven't had this before, but I do think we are seeing some really interesting ones. I mean, even something like Moonshot in the US, that was, outside of the New York issues, that's an Apple Pay on ramp. The holy grail of the on ramp is Gmail login, Privy Wallet, Apple Pay on ramp.
Yep.
And I think we are actually getting there today. either in the App Store or a PWA. But there are some really nice experiences. Farcade, like I don't know if you play with that one in the Farcaster app. You can just play like mini games on
Okay.
there. Surprisingly smooth. I do think the next wave of, at least on the consumer side, is going to be mobile first, and it leans on on the payment side to remittance apps, peer to peer payments. On the DeFi side, where it kind of blends DeFi and consumer. But yeah, I would argue it's actually happening today. And it's an area we've particularly been excited about, like mobile first, crypto native, with a really good UX. I think is pretty magical.
Yeah, agreed. I'm gonna give my own example. Slingshot UX on mobile is fantastic. It's a trading, and you can trade on whatever chain you want, and you don't have to deal with gas, etc. It just allows you to do it. I don't know if it has Apple Pay. I need to check. I hope it has Apple Pay, and if they don't, they should get it on. I guess with recent Apple changes, we're gonna see more and more applications on the App Store and less PWAs, because I feel like PWAs are always less than ideal.
Agree. Yeah, the holy grail here is to be accepted into the App Store, and
Yeah.
until we have enough of the population using the Solana phone or whatever. Yeah, I think that's probably the path of least resistance.
Yeah. If you are talking to a company or a new project and they say we want to launch on chain X, do you tell them, actually, I think it makes more sense for you to go? Like for DePIN, I imagine a lot of people's first thought is Solana, just because there's so much DePIN on Solana. Is that something that you guys also iterate to them and say, hey, like it makes sense if you go to this chain actually because it's doing better in terms of attention, or there's like more support, or the tooling we've heard is much better? Or is that something that you don't really talk about with them?
Yeah, there's nuances here. I would say two things. One is that as a startup, your general goal is to not die. And the more risk you take, because you already have a 95% chance of dying, right? So why bump that up to 98 if you can avoid it?
Yeah.
So I think if it is consumer, base is probably the least risky. Solana is probably the least risky. If it is DeFi, Arbitrum is not very risky. There's a lot of DeFi on there. I hold no bags in all of these, by the way. It's just like observations.
Yeah.
The nuance is that if you are building something novel and you get distribution, you can choose whatever chain you want, because the end users probably don't know. And there's a lot of very performing chains now that can do block times sub-second. And that's like good enough UX, provided there's a good enough on and off ramp. But like Pump is a good example of saying we own the end user, we commoditize everything underneath, and we've seen the success with Pump Swap. I have not spoken to him about this, but I do assume there's going to be a Pump chain, and you just like vertically integrate all the way down. Pudgy with Abstract, so I do think going top down after you have distribution is very doable, and then you're much less, I don't know, beholden to any specific L1 or L2.
That makes sense. I feel like Polygon, a Poly market is somewhat of a good example of that, where like it gets users. Polygon is not like a fantastically active chain, but it still works well. I want to ask a bit about consumer crypto. What are you excited about? Is there anything that you think people should specifically focus on? I feel like consumer crypto sometimes gets kind of muddy because we do a lot of trading, like retail trading goes into consumer crypto, social buy goes into consumer crypto. So either of those is fine. But which one do you see? I guess like what do you see coming up over the next year, 2 years? Where do you see it going?
Yeah, and I think that's the point in that we are seeing a lot of genres blend. I've seen teams tried to take the approach of Robinhood democratized options trading effectively, and if you've used the app, the UI is really intuitive, and it really nicely lays out the payout functions for you. And I think we're seeing that with these SocialFi apps. I do not turn away from speculation. I'm not one to judge what PMF looks like. And I think there's still a lot of demand there. And the moonshots of the world have shown that good product and good UX can get you distribution. I think the rise of generative content is very interesting. And I think there's a lot of unique value that crypto can offer around attribution and monetization. And there's a spectrum where it can be something super simple, like a meme or an image, to something more complex, like a game. From a mini game to more complex ones, I do believe in a few years, we will likely have a new foundational model or some fine-tuned model that is specifically focusing on game generation. And so if creating games is as simple as a prompt, then you get into this market structure of ephemerality, I suppose, and just like a oversupply of content. And I think there's a lot of interesting areas for crypto to be used as the mechanism for attention and as the carrot, I suppose, to actually bring I guess like developers or content creators onto a platform. If they know if the game that I made or the image that I made is being remixed and I have some kind of attribution or creator reward there, I think that would be quite interesting.
Yeah, that makes sense. We just saw Pump Fund implement 50% fees to creator fees. I know that's on the meme coin side, but I imagine we'll get more and more and more. This is a non-crypto related question and a non-investment related question. I just kind of want to hear your thoughts on it. You mentioned that in a few years, a foundational model might just be able to spit out a video game based on a prompt. How do you see that change the way that you and I value something? Like if you can create a game just off a prompt, do you think that's worth the same as somebody who spends 3 years building out a game, an indie game? Because I feel like this is something that we're going to get more and more of with image creation, art, everything. So curious to see if you have any thoughts there.
It's a philosophical question and one that we will need to see how the market values it. I think that in 5 years, only 5% of the content online will be human generated, and I think that cuts across all of the use cases. And I do think there will be a premium in certain use cases. Let's call it the humanity premium. I think for things like games, I don't think that's something that to speculate, I suppose, what an end user cares about. I think they primarily care about the utility and the game mechanics and the fun that they're getting from it.
Yeah.
So I don't know, bearish game devs, bearish musicians. I don't know if you've used any of those. um, uh, Suno, I think it's called.
Yeah. Very
Where
good.
yeah, it makes some great music.
Yeah.
And I think there's going to be a lot of very deep implications of how we value things, and it has deep implications on what the nature of work looks like. um, I think that's going to be a fascinating thing, and we're seeing it today. It does have education as well. Like do people value that a professor said something, or do you know what I mean? Like they just want a piece of paper saying that they learned something
Yeah.
from a university. You can learn everything just like skill maxing on Chat GPT for I did that for like 4 hours last Friday on just like energy markets. You know, um, and I think it'll redefine a lot of business models, and really like bring to light what people actually value.
Yeah, I completely agree. Related to this, do you use? I mean, you just mentioned that you skill max energy markets last Friday, but how? I guess how has your investment changed? Like the way that you guys do investments and the way that you do DD and like how you work on your side. How has AI changed it? Has it cut down your time significantly, or is it?
We have not yet. We've been thinking about it. One of our portcos is one called Exo. They
Oh, I
do
know that.
edge compute. So you can run like a mini, like a Mac Mini data center in your office. For us, a lot of the concern is, we have a lot of internal due diligence notes and memos, and we don't feel comfortable with that going in the cloud. So can we create, a tiny Exo cluster and then fine tune like a Llama model on all of our DD and have just like a AI analyst? And I'm sure funds are doing that. I've spoken to like a DAO that's trying to do exactly this. I think that'll happen. And it's interesting because there were approaches to this even pre LLMs. I believe there's a fund called Signalfire that was trying to use AI to do better deal sourcing and diligence. Fact check me on that. But there's always been the question of like, how do you extend? Um, it's been an idea, but it's not something that like we've actually done. But probably a competitive advantage for someone who's productized this.
Yeah, I that makes sense. I'm only asking because we on our end. I mean, you can imagine. I think all of research is kind of in a spot where it's changed drastically. Like deep research is fantastic. So we've been thinking more and more on our end, like how to utilize it, and it does. It saves you a lot of time, and we don't really have the internal notes that we have to be really, really careful about. So I think we get off a little bit easy. Um, it's gonna be interesting. Let's see how everything shapes up. I want to ask one last thing, somewhat tangential. AI agents being mostly on chain. I guess AI agent commerce being mostly on transactions, on AI agent transactions being mostly on chain. I think that makes sense. Um, I want to ask, why won't they just be able to use, I guess, the traditional banking system? Is it just because it's too slow, settlement takes too long, or is it just it's easier for them to do everything on?
Yeah, I think it's as simple as like, how does, to open up a bank account, you have to, walk in a branch, or go online and provide pieces of your identity. And, pieces of code don't have an identity. So, at least in meat space. So how do they get bank accounts? And I think that's really it's a great fit, because you can't have, a public private key pair. that is designated to an agent, and then they can have a wallet and they can send and receive funds to and from other agents, to and from other people. We'll put this in the bucket of Balaji's always right, with what he was doing with 21 Co. But it's less of like your fridge paying your toaster with Bitcoin. But it's more so like using stable coins and having that be agents around the world paying each other in micro transactions for specialized jobs that each agent can do. And yeah, blockchains and crypto rails are really the perfect medium for that. Because you can actually have a cost structure where you can do transactions in fractions of a cent. So we of course have not seen many of those use cases today play out. But I think it's also because we are waiting for, I suppose, like more performant agents with more utility and better orchestration frameworks to actually coordinate. Like the meme of like agent swarms. I suppose, but that's on a 1 to 3 year time horizon.
Yeah, I think that makes sense. I have used one AJet style protocol, which was on Ethereum, which I felt like was the wrong choice for it because it's very expensive, and then I will say I'm kind of surprised that agents haven't become more like in not real life. I guess like non-crypto agents haven't become more popular. I feel like it would have been here by now, but I guess it takes quite some time for it to figure out. I think the only use case right now is coding. Maybe have you seen anything else?
I mean, that alone is, I think, really interesting. I think with Operator, which is OpenAI's product, I think that will give agents almost like arms into the real world. I think we're on the cusp of it. The pace of innovation is pretty mind blowing. So it's always like, things are closer than what they may appear. I put that on, a 3 to 6 month time horizon, probably.
Interesting. I'm hoping so because I have so much stuff that I just want to delegate off to some like agent and just leave me to do my whatever I want to do instead. Dmitriy, I think that was perfect. I think that's it. Thank you so much for coming on. This was fantastic.
Yeah, this was fun. Thanks for having me.